So what is real property tax anyway? Well, in New York State, it's a tax that's raised and spent on the local level to finance public schools and local government services, enabling a community to function. Real property is generally defined as land and any permanent structures on it. And in New York State, all real property, also referred to as real estate, is subject to taxation unless exempted by law.
The total amount of property taxes to be collected, also known as the tax levy, is determined by the taxing jurisdiction, the school district, county, city, town, or special district, such as a fire or water district.
Once the total amount of taxes to be collected is determined, the taxes are allocated based on property assessments. Your property's assessment is determined by an assessor, and let me begin by saying that this is not an easy job.
By law, the assessor is responsible for assessing all real property at a uniform percent of value each year. To do this, the assessor should establish a fair market value for each property and maintain accurate and current inventory data for all parcels annually. And if you take into account that most towns have more than 2,000 parcels of varying types of property, this can be a staggering job each year.
Well, the main role of the assessor is to achieve equity amongst the assessments for the houses and commercial properties in the town. One of the hardest things to do is to achieve equity. So you have like properties assessed alike. They need to be equal and they need to be uniform across the whole town. You can't have different houses or like houses at different levels, and you've got to have commercial properties and everything that you have all at the same level. That is the most important thing we do.
Assessors also need to be able to analyze the real estate market and to conduct sophisticated statistical analyses in order to value properties. They work closely with the public and conduct public education sessions, and they review and process a wide array and number of exemption applications.
An assessor for a town has to assess many different types of properties. The majority of them are going to be residential. Probably the next classification would be vacant lands. Each town has commercial properties. They come into play. In addition to this, you have things called special franchise properties, which are property in the public right-of-way. There's also ceiling properties on railroads. So there's a lot that goes into it other than just a residential home. So primarily I would do residential homes, vacant lots, and farms.
And all of this work needs to be done while complying with the many deadlines associated with the assessment calendar. This is a tall work order, to say the least, and in order to accomplish all of these tasks on time, assessors need adequate funding, staffing, technology, maps, office space, and equipment. Assessors also need to be well trained, which means obtaining basic New York State certification through the Office of Real Property Services within 3 years of taking office.
You almost have to be a lawyer, an appraiser, a computer person, and a lot of other things rolled into one.
Okay, let's talk a little bit more about the specific job duties of assessors. The assessor is responsible for preparing something called the assessment roll. This document contains the assessment on each property. Now, as we mentioned earlier, an assessor is also obligated by New York State law to maintain these assessments at a uniform percent of market value each year. To ensure assessments are fair, the physical description or inventory and value estimate of every parcel need to be kept current.
A lot of work goes into maintaining a municipality's assessment roll each year. This process should begin with your assessor analyzing all of the properties in the municipality in order to determine which assessments need to be changed. Because the real estate market may affect the values of some types of properties or some neighborhoods more than others, in any given year, the assessments of some properties may need to be changed while others may not. In order to know how the real estate market is changing, the assessor also reviews every transfer of real property for accuracy, including the basic information on the buyer, seller, and sale price. Assessment records are then updated, and any unusual conditions affecting the transfer are also verified. These results are recorded on Form RP 5217 at the real estate closing and then typically filed at your county clerk's office. Many other administrative functions go along with the assessor's job, as well as inspecting new construction and major improvements to existing structures. This not only ensures that the record of each property's physical inventory is current, but that the appropriate improvements are assessed as well.
So how is a property's value assessed anyway? Well, there are a variety of approaches. However, the most common method for estimating the value of residential properties is something called the market approach, which involves comparing a property with other similar properties that have sold in similar neighborhoods, giving consideration to other factors possibly affecting market value. Once the assessor estimates the market value of a property, its assessment is calculated. We know that all assessments within a municipality are required to be assessed at a uniform % of market value. This means that all taxable properties in your city, town, or village must be assessed at market value or all at the same % or fraction of market value each year. The % of market value can be 5%, 20%, 50%, or any fraction not exceeding 100%. And if a town assesses at 100%, it does not mean that taxes will be higher than if they assess at 50%. Quite to the contrary. As we noted earlier, the total taxes to be collected are determined by taxing jurisdictions separately from assessments. As a result, the % of market value used for assessments doesn't affect the amount of taxes you will pay. Regardless of what % of value the municipality uses, if all of the properties are assessed at the same %, each property owner will pay taxes based on a fair assessment.
For example, a house with a market value of $100,000 located in a town that assesses at 20% of value should have an assessment of $20,000. When it comes time to send out tax bills, the assessment is then multiplied by the tax rate for the appropriate taxing jurisdiction, city, town, village, school district, etc., to determine the amount of taxes to be paid.
Ultimately, the assessor's job is to ensure that assessments are fair for each and every property owner. I think I speak for everyone when I say no one wants to pay more than their fair share of taxes, right? However, that's just what happens when assessments are not kept up to date each year. And if assessments aren't fair, those who are overassessed are, in effect, subsidizing the tax bills of those who are underassessed. For example, let's look at a town that hasn't updated their assessments in 20 years.
In the 1980s, Mrs. Smith and Mrs. Jones owned homes that were each worth $100,000. Now, as we all know, the value of real estate has changed dramatically since that time, and any realtor will tell you that a lot of factors affect the changing value of a home. So, we fast forward 20 years and find that Mrs. Smith's home is in a more affluent neighborhood, and she's made some improvements to her home. As a result, she could now sell her home for $300,000. Meanwhile, Mrs. Jones could sell her home for $150,000. However, since the town hasn't conducted a reassessment, both properties are still assessed at the same $100,000 value. As a result, even though Mrs. Smith's home has dramatically increased in value, while Mrs. Jones' home has increased only moderately, they're still both paying the same amount of taxes. So, to put it quite simply, Mrs. Smith is paying less than what she should be, and Mrs. Jones is paying more than her fair share. Mrs. Jones is therefore actually subsidizing Mrs. Smith's tax bill. Now, increasing both Mrs. Smith's and Mrs. Jones's assessments to accurately reflect their new market values will not collect more taxes for the town. Rather, it simply redistributes the tax burden based on the current value of each property owner's home. In this example, let's say that Mrs. Smith's and Mrs. Jones's homes were the only two properties in a town, and each was paying $2,000 in taxes based on their old $100,000 assessments. If their assessments were adjusted to accurately reflect their market values, the total taxes collected from the two would still be the same, $4,000. Based on the new assessments, Mrs. Smith would now pay $2,667, and Mrs. Jones would pay $1,333, again adding up to $4,000. Put another way, when the assessor reassesses property or makes changes to assessments, it does not raise more taxes for the municipality. Again, increases in taxes are determined by school districts, counties, and municipalities, and are reflected in increased budgets and tax levies.
So how does the town ensure everyone is assessed fairly? Frequent reassessments. Internationally, it's widely recognized that frequent reassessments are the single best way to ensure that each property is assessed fairly. Many municipalities conduct reassessments each year, and others reassess on a periodic basis. It is to the taxpayer's benefit when reassessments occur frequently, because it ensures that each property owner is treated fairly. When assessments are not fair, some property owners pay more than their fair share of taxes while others pay less than their fair share. So, there you have it, a quick look into assessments and real property taxes. If you have any questions or need more information, please log on to the State Office of Real Property Services website at the address on your screen. Thanks for watching. And remember, it isn't the job of the assessor to raise or collect taxes, but to ensure that your assessment is fair and equitable.